Sensex and Nifty have been scaling greater heights, closing at record highs. But the same is not being reflected in our portfolios. The pain is particularly felt in the mid and small cap sectors. To understand what is happening in the markets, what we need to do and how to invest, we have with us Mr. Satish Menon, Executive Director, Geojit. He has over 30 years of experience in the financial market sector. Welcome to the show, Mr. Menon. The markets have been rising, but sans the euphoria. Mainly, I think it's because of the mid and small cap stocks not doing very well. This makes investors nervous and they would like to stop investing. What do you think they should be doing in such a market?
Very pertinent question as of today, but the answer to this probably lies in the question, why did they start really investing in equities? The basic fundamental there has not changed. Equities are supposed to be for long term. If your horizon is less than 3 years or 5 years, we do not recommend equities. And if you have a long term vision, this small upheavals what you have seen in the last 6 months in the small and mid cap should not bother. If you see over a long term, whether your period is 5 years or 10 years, even this mid cap and small cap has also performed. It is normal to see that when the market is corrected, the small cap and the mid cap falls more than the large cap. What has happened in the last 6 months is you have seen very few select stocks of Nifty and Sensex going up. So, about 8 to 10 stocks of Nifty, 8 to 10 stocks of Sensex, these have gone up, but largely the other major stocks of these Nifty and Sensex have not gone up. But whereas in case of mid cap and small cap, you have seen a larger erosion in prices. Some stocks are down 50% plus, there are many stocks which are down by 30% plus, which I think is natural. What we have seen over the last 2-3 years especially, the prices of mid and small caps had gone up much larger in proportion to their growth in earnings. So, there was a craze there. So, there was a craze, so the lot of money was after this mid and small cap. So, the prices in some of the cases or most of the cases were slightly above the intrinsic value or the price you could pay. So, that has corrected. Unfortunately, that correction has come in very steep. So, in 6 months you have the mid cap index fallen down, whereas in the similar 6 months you have seen the Sensex and the Nifty hitting new highs. So, it is a logical question in terms of when you read the newspapers, you will say that markets are new high, but when you look at your own portfolio, it might be down 20% or 50% depending on what kind of stocks you have. But my point is, again I come back to the reasons of investing. It is a long term investment. Yes, if you had started investing 6 months back, you are having a problem. My answer to this would be wait, have patience. If your choice of stocks are good, you will definitely make money in the long run. If your choice of stock is bad, whether it is mid cap or large cap, you are bound to lose money. So, I do not think people should be unduly bothered as of today because of the erosion in prices in 6 months. Give time to equities, equities performs well over the long run, and I am sure the history shows that mid cap, small caps have given better return than large cap, but you have risk also. More the risk, more the return. So, when you have risk, you are supposed to see such kind of short term volatility and you have to live with it.
Okay. And so, you were saying that there was a deep correction. Now, the financial medias have been saying there has been a decline, there has been a plunge. What do we mean by deep correction? Were the values wrong, or this is generally for the…
So, there are mix of reasons. I just said that in some cases, the prices of the stocks had gone up much beyond the price you could normally pay. In some cases, the future expectation is built much more than what you could expect for the short term. People were started pricing based on 2020-21 earning. So, all those things, euphoria was there. So, PEs went up from 15 PE to 35 PE, 45 PE for certain mid and small cap stocks. And also you need to understand, mid and small cap stocks have lesser volumes. The transactional volumes in the exchange is much lesser than the normal large cap stock. So, when there is a seller, the seller does not get the depth. When the seller does not get the depth, he still has to sell. So, the prices crash. So, this is a phenomena which will be there in mid cap, small cap stocks, the lack of volumes. Lack of volume has its own advantages and disadvantages. When it goes up without much volumes. Similarly, when it comes down also without volumes. So, I do not think we need to be perturbed. If your choice of the company is good, you stay invested. The paper jargon of a crash, etc., need not be taken too seriously as at this juncture if you are very comfortable with the choice of your stock. If your choice of the stock is good, please continue to stay invested. If your choice is wrong, you need to take a decision what it is. But the 6 months movement should not make you change your philosophy in investing in equities, because equity is for long run. Short term money should not come into equities.
Okay, sir. So, when we move on specifically to SIPs, many of them stopped the SIPs, they redeemed, fearing they would lose more money. What would your advice be to such investors, and why they should stay invested? How is it beneficial to stay invested at this juncture?
The biggest mistake that somebody makes is stopping of SIP. SIP is done for a goal. For example, your goal may be you want to retire peacefully and you have 15-20 years to retire. So, that is a long term. So, the short term movement of 3 months or 6 months should not affect. In any case, stopping an SIP is bad. You lose your objective of starting it. You understand what I am trying to say. So, this short term movement definitely should not force you to stop your SIPs, whether it is large cap or small cap. Now, having decided to invest, so what we normally tell our clients is 60% of your money should be in large cap. Balance 40% you can look at flexi, mid cap and small cap. But what you have seen over the last 6 months, yes, you have seen Nifty going up by 6%, you have seen the NSE mid cap going down by 5%. So, there is an variance. People are looking at newspapers and index, the index is going up, broader index is going up, but his portfolio is going down, which is okay, which you have to understand it happens in a shorter period of time. When you look at a 5-year return of an SIP, for example, when you compare a 5-year return of a large cap or a 5-year return of mid cap or small cap, similarly for a 10-year return, you have always seen that in the last 10 years or 5 years, the returns from SIP from mid cap and small cap is slightly more than the large cap. So, you need to have patience. Like I said earlier, there is a risk reward. Mid cap, small caps has a higher risk. So, you need to see this short term fluctuation. But over the longer run, you will definitely make money. That is what history shows, and we have no reason to believe that in the next future this will not repeat. So, whether it is large cap or mid cap, you need to have patience, you need to let your money work for you.
Sir, could you explain the concept of rupee cost averaging?
Okay. So, this pertains to SIP. So, the theory of SIP is you invest a certain amount periodically, and mostly this period is 1 month. So, you invest, let us say you put in a date of you will invest 10,000 rupees on 5th of every month, which means on 5th of every month 10,000 rupees is debited from your bank account and it goes to the SIP you have chosen. Now, what happens is this 10,000 rupees is invested by the mutual fund into the markets. So, let us say today's NAV is 10 rupees. So, the 10,000 rupees is going to be invested in buying this mutual fund which has an NAV of 10 rupees, which means you will buy 1000 units of that mutual fund. So, 1000 units into 10 rupees is 10,000 rupees. Next month, let us say the market goes up by 10%. So, the NAV becomes 11 rupees. Your investment amount remains the same at 10,000 rupees. So, what happens is you will get lesser number of units. So, 10,000 rupees divided by 11, you will approximately get what 900 odd units, that is comes to your account. Next month, let us say the market corrects by 20%. So, instead of 11 rupees, the NAV is at 9 rupees. You still invest the same amount, 10,000 rupees. That month, you get more than the 1000 units, you get close to 1100 units. So, what happens over a period of time? You average out your cost. The monthly ups and downs in the NAV averages out your cost. That is known as rupee cost averaging. So that is the whole charm of SIP. When your market is up and down, you actually gain from this fluctuation. So pertaining to your previous question, when such times in the last 6 months, when you have seen, particularly in the mid and the small cap, the NAV going down, it is actually a good time not to stop your SIP, actually increase your SIP, so that you are benefited by a larger units with the same amount. This builds up in the long run, because you suppose you do an SIP for say 5 years, that is 60 months. 60 months it is averaged. So your average makes your life much more easier in the long run. But in the short term, like you said, you had started an SIP 10 months back, probably in last October to January, you were always investing in a high market. When it suddenly falls down, your 10 rupees have gone to 8 rupees, you are panicked. Actually no, actually it is good. In an SIP, it is always better that you get at least some units at a lower cost if your horizon is 5 years. So it is a good thing actually the market is correcting, so that you get the benefit of cost averaging.
And I think over a few years, the market does go through a couple of ups and downs, and
of course, that is why the market is.
Yeah.
If the market has one-way trajectory, then nobody will sell. So there are people who wants to sell, there are people who wants to buy. All demand and supply, economic factors, everything depends. Everything moves the market. So that is the whole charm of the market. Nothing can move one side up always.
So sir, as you were saying, you shouldn't consider short-term volatility while investing. But how often should an investor look at his portfolio, and when should he rebalance it?
You should not look at your portfolio daily, which is the biggest mistake which normal people do. If you have investments in mutual fund, I would say that twice a year you should look at the portfolio, and you should give some time. It doesn't mean that if your mutual fund scheme has done badly or has done not according to the market, you should change. You have to give some time. It is not always that you will see a linear curve. Over a longer period, if you are beating the benchmarks and if it is still recommended, you are supposed to stay invested. So maximum twice a year is what I recommend for a mutual fund scheme. When do you rebalance? Rebalancing happens when you meet your objectives. Like I said, each of your investment is based on a particular goal. So when you are near to reaching that goal, you should think of rebalancing. So this is rebalancing is in terms of your total investments. Whether you should change your scheme to something, or from one scheme to another, it's a different question. That has to be done every 6 months or 1 year after looking at for a longer time. So if your portfolio is not doing well compared to the benchmarks over a longer period, say 1 year, 1.5 years, then you should look at rebalancing to a different scheme. But as an investment as a whole, your equity is there, you have a goal of 10 years, please wait for 10 years to rebalance.
So to tie up all that we just discussed, we shouldn't worry about the current market scenario, just stay invested, find the right funds to be invested in and stay invested for as long as you meet your goals. So thank you, Mr. Menon, for speaking to us.
Thank you very much.